Okay, let's unpack this. Imagine you've invested in a beautiful slice of paradise, maybe a stunning villa over in Thailand. You've watched its value grow, which is great, and now you're thinking about selling. It's a big moment, right? Significant financial decision. But then that thought pops up, the tax man, specifically capital gains tax. It's not always straightforward, is it? And really getting your head around it can mean the difference between a good return and, well, a truly great one.
Indeed. Yeah, our mission today is to try and cut through some of that complexity. We're doing a deep dive into the nuances of capital gains tax in Thailand for property sales, and we're focusing specifically on Phuket. That's Phuket, pronounced Phuket, for anyone new to the region. We really want to equip you, the listener, with the knowledge to make informed decisions, turn those potential headaches into, strategic advantages.
Right. And to guide us through this pretty intricate topic, we're drawing insights from an article. It's called Phuket Property Sales, Navigating Capital Gains Tax in Thailand. It's published by Ocean Worldwide. Now, they're a luxury real estate agency, and they've got significant experience based right there in Phuket since, 2004?
That's right, since 2004. Their director, Sandra O'Neill, she's advised thousands, literally thousands of families and property investors over the years.
Wow. And what's particularly valuable, I think, is their specific lens. They focus on luxury residential real estate spanning both Phuket and Koh Samui. So that gives us a really focused perspective on this particular market segment.
And here's the first major takeaway from our deep dive today.
Yeah.
Thailand often treats capital gains from property not as a separate tax, but actually as part of your income. And the rates can be surprisingly high.
As income. Okay, that's interesting.
Yeah. This isn't just a minor detail. It's a critical strategic point. It basically means your tax planning needs to start not when you sell, but the moment you actually buy the property. Ignoring this, it's like, building a house without laying the foundation first. It really underscores why proactive tax planning is absolutely key to structuring your investment tax efficiently.
That's a really powerful way to frame it. So, okay, let's strip away the jargon. Let's get to the core. What is capital gain when we're talking about selling property in Thailand? Our deep dive showed it's maybe not quite as simple as just buy low, sell high. The details around how it's calculated seem, well, pretty fascinating and crucial for your bottom line.
Well, simply put, capital gain is the profit you make. It's when you sell a property for more than you originally paid for it. It reflects the property's value growing over time minus, what it costs you to buy and improve. The article definitely emphasizes this is often the main driver for property investors. But, like you said, it's not just a surface-level calculation.
Right. I imagine it's not just selling price minus purchase price, is it? As an investor looking at their profit, I'm curious if there are crucial deductions that savvy investors absolutely shouldn't miss out on.
Absolutely. Yes. And this is where meticulous record keeping becomes, your best friend, honestly. You start with the selling price, okay? Then you subtract the original purchase price. But then, and this is critical, you can also deduct specific allowable costs. Think about things like legal fees, both for the initial purchase and the sale later on. Also the cost of any major renovations or significant improvements, things that genuinely added value. Real estate agent commissions too, and those government transfer fees. We've seen situations where, a missing receipt for a big renovation could literally cost an investor tens of thousands in lost deductions. It's truly a case of your paper trail is your profit trail.
Okay, that makes sense. So beyond the tax side of things for a moment, what generally makes a property's value go up in a market like Phuket? What should we, as potential sellers, be keeping an eye on?
Yeah, good question. The article lists several key factors that often drive that appreciation. Location is, paramount. Popular areas, developing areas, they consistently see bigger gains. Think beachfront or places near new international schools, maybe emerging hospitality hubs.
Right.
Property condition is another big one. A well-maintained place or one that's been recently renovated, it almost always fetches a better price. Then you've got the broader market trends, the general economic situation in Thailand. That can significantly influence investor sentiment. And finally, things like new infrastructure projects nearby, maybe road expansions, a new airport terminal, those can dramatically boost values. It's a complex mix, really, of all these elements. For you, the listener, this isn't just academic stuff. It means keeping meticulous notes on any improvements you make and staying up to date on local development plans. These insights are your toolkit, really, for assessing potential gains and getting ready for that eventual sale. And building on that, if we connect this to the bigger picture, Thailand's tax system is, it's remarkably dynamic. What was true last year might not be the case today, which means a sort of set it and forget it strategy just won't work for property investors there.
Right, things change.
Exactly. You need to stay updated with new rules, how they might affect your investment, whether that's income tax, capital gains, or other property-related charges. This constant evolution is why ongoing vigilance is just paramount.
That sounds like it could be a bit of a minefield, especially for international investors. So, for those of our listeners who might be international, what are the specific rules and considerations they really need to keep top of mind?
Yeah, crucially, for international investors, you're not just dealing with Thai tax laws. Often, there are cross-border implications with your home country's tax system, too. This is where you might face the risk of being taxed on the same income twice. Ouch.
Double taxation.
Exactly. And that's precisely why double taxation agreements, or DTAs, become such a critical tool. They're essentially treaties designed specifically to prevent that unwelcome double dip. The article also highlights that how you own the property, like as an individual versus through a company, can lead to vastly different tax outcomes within Thailand itself. So understanding these cross-border interactions and the local ownership structures is vital to avoid paying more tax than you absolutely need to.
Okay. So beyond that initial calculation of profit and those crucial deductions we talked about, are there other ways to legally minimize the tax bite? Any less obvious avenues for savings, maybe?
Absolutely. The source points towards identifying a broader range of allowable investment expenses. This goes beyond just the direct purchase and sale costs. Think about ongoing things like property management fees, routine repairs and maintenance, insurance premiums, even mortgage interest in some cases. Again, that detailed paper trail isn't just a recommendation. It's like your financial shield. No documentation, no deduction. Simple as that.
Makes sense.
And then there's something called property depreciation benefits. This is a bit more complex, but it can be a potentially significant non-cash deduction. Think of it this way. And the tax authorities kind of acknowledge that buildings wear down over time, right? This wear and tear isn't actual cash out of your pocket each year, but you can declare a portion of the building's value as an expense against your income. It effectively reduces your taxable income each year. It's a more sophisticated tool, but it can significantly impact your annual tax bill.
Now, this next point really caught my attention in the article. Those double taxation agreements, DTAs you mentioned, what exactly are they and how do they practically help an investor on the ground?
Right. So Thailand has these DTAs with over 60 countries. And these are formal international treaties. Their whole purpose is to prevent you from being taxed twice on the same income. For property investors, this can apply to both rental income and capital gains from a sale. The key is, first, you need to check if your home country actually has one with Thailand. Then you need to understand its specific terms, because they do vary from treaty to treaty. And crucially, you have to keep good records and actively claim the benefits. They don't just happen automatically.
Ah, okay. You have to claim them.
Yes. These agreements often specify which country has the primary right to tax certain income, or they might provide credits for taxes you've already paid in the other country. So let's say you've paid tax on your capital gains in Thailand. A DTA might allow you to claim that amount as a credit against your tax bill back home, meaning you effectively only pay the tax once on the higher of the two rates usually.
That's a huge clarification. These aren't just, dry legal terms buried in documents. These are tangible ways for you, the listener, to protect your investment and make sure more of that hard-earned profit actually stays in your pocket instead of going to two different tax authorities.
Okay, so given all this complexity, the dynamic tax system, the international stuff, the deductions, the DTAs trying to navigate this all alone, sounds like, well, a recipe for a monumental headache. Or maybe worse, a really costly mistake.
Indeed. Yeah, the source strongly advises securing expert advice. Local lawyers and tax advisors are pretty much indispensable. They understand the nuances of Thai law, the intricacies of foreign ownership rules, the specific tax implications for different property types, and most importantly, how to structure your investment tax efficiently right from the outset, before you even buy. This includes guidance on everything: ownership structures, tax declarations, capital gains, rental income, even inheritance matters down the line. They can help you clarify exactly how profit from selling property is generally subject to tax and what deductions are really available in your specific situation. And presumably, a good local real estate agent, like the team at Ocean Worldwide you mentioned earlier, they can also be a vital first point of contact, even before you get the legal and tax experts fully involved.
Precisely. Yes. The article notes they offer invaluable market feel. They can help you with fair pricing, understanding realistic rental yields, and, crucially, helping you avoid potential pitfalls, like properties with unclear titles or maybe non-compliant buildings, things you might not spot yourself. They know which areas are performing well, which developers have a good reputation, and can give you a realistic picture of property values. They act as a crucial guide, especially during that initial purchase process. Their local expertise is a huge asset.
You mentioned ownership structures earlier, too. This sounds like one of those really critical day one decisions you need to get right. What are the common ones, and how do their tax implications truly differ in practice?
Yeah, this is absolutely fundamental. A strategic decision, especially for international investors, because of those restrictions on foreigners owning land directly in Thailand. The article details several common structures. First, there's direct freehold. This usually applies to condominiums, where an individual can own the unit outright. This typically leads to personal income tax on any rental income, and then capital gains tax assessed personally when you sell.
Okay.
Second, Thai company ownership. This is very common for houses or land. A Thai-registered company holds the property. This involves corporate income tax on the company's profits, and then there are different rules for how dividends are distributed to the shareholders, which might also be taxed.
Right. Different layers.
Exactly. Third, leasehold agreements. Here, you lease the land or property for a long term, often 30 years, sometimes with options to renew. These have varying tax treatments based on the lease terms and duration. Selling the lease rights can sometimes be treated as income, sometimes as a capital gain. It depends. And finally, the article mentions the strategic use of holding companies, maybe local or even offshore. These can sometimes offer advantages for managing capital gains or handling dividend distributions more efficiently. For instance, an offshore holding company might allow tax deferral until funds are brought back home, or potentially benefit from different tax treaties. It can offer more flexibility for long-term wealth management. But each path, as you can see, carries really distinct tax implications. So getting tailored advice on which structure fits your situation is essential.
Wow, that level of detail really highlights the upfront planning that's needed. It's not just about finding a nice villa. What about buying properties that aren't even built yet? Off-plan properties. Do taxes apply differently in those scenarios?
Yes, they often do. The article highlights some unique tax angles for unbuilt properties, and this is a crucial distinction to understand. When you buy off-plan, you're not initially buying a completed asset, right? You're often buying a right to acquire that asset later. The Thai Revenue Department might classify this initial transaction differently, maybe more like a contract for services rather than a direct property sale. This can fundamentally change how taxes like VAT might be applied and what your obligations are if you decide to sell your contract before the property is even completed.
Ah, so selling the contract itself is different tax-wise.
Potentially, yes. The tax treatment of any profit you make selling that contract before completion can differ significantly from selling a finished property later on. Also, developer due diligence becomes even more critical, not just ensuring they'll actually finish the project, but also checking their own tax compliance, because issues on their end could potentially complicate things for buyers. Even how you structure the payment plan can have tax implications, especially if you're transferring money internationally. It's wise to discuss your payment schedule with a tax advisor in these cases. And all this really raises another important question. It's not just what you buy, but how long you hold on to a property and how you eventually sell it. These factors can significantly impact your final tax bill.
So timing and the method of sale are just as crucial as the initial purchase strategy.
Yes, very much so. The article really emphasizes that longer holding periods generally lead to more favorable tax treatment in Thailand. Short-term ownership, like quick flips, can sometimes attract higher capital gains rates, almost acting as a disincentive. Furthermore, comparing a direct sale of the property itself versus, say, selling the shares in the Thai company that owns the property, these can have vastly different tax consequences. Each method has its own set of rules, potential deductions, and associated costs like transfer fees or stamp duties.
Okay, so selling the company versus selling the asset. Different outcomes.
Potentially very different, yes. And strategic timing is also highlighted. Aligning your sale not just with favorable market conditions, but also with any anticipated changes in tax law could be beneficial. Adjusting your selling timeline by even just a few months could potentially save you a significant amount in taxes, which means your exit strategy really needs to be part of your initial investment plan from day one.
So with all these complexities, these evolving regulations we've discussed, what does this ultimately mean for the future of the luxury property market in Phuket? How are these tax considerations likely to reshape the landscape there?
Well, our deep dive really illuminated some potential shifts for the luxury property scene in Phuket. The article suggests a pivot, a move towards what it calls recalibrated investment strategies, Investors won't just be looking for beautiful villas anymore. They'll increasingly be investing in tax-efficient structures. It's becoming a core part of the decision.
So the structure is as important as the view.
Increasingly so, yes. This isn't just about chasing market trends. It feels like a more fundamental shift in investment philosophy for that market. The source points to a potential short-term dip, maybe, in valuations for some of the really high-end places as the market adjusts to these tax realities. But this is expected to be followed by a period of greater stability as the market kind of adapts and incorporates these factors. This could lead to an increased focus, perhaps, on properties that offer strong, consistent rental yields. Investors might prioritize reliable income generation more. It also points towards a likely shift towards longer holding periods, partly to mitigate those tax liabilities we talked about. And crucially, an even greater demand for sophisticated professional advice, legal, tax, and real estate. Ultimately, the idea is that a clearer, more stable, and better understood market, even with these tax considerations, actually builds confidence for serious long-term investors. It could create a more appealing and, properly regulated environment.
Hmm, that makes sense. Understanding these shifts helps you not only make a smart individual decision for your own investment, but also see how the broader Phuket market is evolving and where future opportunities might actually lie. So, what does this all boil down to? Our deep dive into capital gains tax for property in Phuket has clearly shown that selling isn't just about finding a buyer and getting a good price. It's really about being informed, being proactive, and being strategic right from day one, from the very moment you start considering that initial purchase.
Absolutely. The core message from our source material today is crystal clear. Proactive tax planning, starting the moment you purchase, coupled with meticulous, almost obsessive record keeping. And leveraging local legal and tax professionals, that combination is absolutely essential to maximize your returns and successfully navigate the Thai tax landscape. This comprehensive approach helps you avoid nasty surprises down the road and manage your liabilities effectively, ensuring your investment truly pays off the way you hope.
So, as this market continues to evolve, maybe shaped partly by these tax strategies, what exciting opportunities might emerge for those investors who truly master these complexities? And how might that reshape Phuket's luxury landscape for the truly well-informed investor? It's certainly something interesting to ponder. We really hope this deep dive helps you feel a bit more confident, perhaps less overwhelmed, about navigating the world of Thai property tax, especially in beautiful Phuket. Till next time, keep digging.